Hello, I'm Cliff Emmons, and my company is Accelerated Healthcare Innovations, and this is Pitching to Investors. First, a little bit about myself. I have an engineering background, both mechanical and electrical. I also have a degree called a Master's of Science in Management Engineering. I like to joke that that's my MBA for geeks. So with that background, I've worked in various industries, including aircraft instrumentation, also automotive aftermarket sensors, as well as industrial sensors, access control. But for over 20 years, I developed medical devices. I worked for a series of companies that eventually became part of Medtronic. My teams and I worked on everything from minimally invasive surgical tools, such as surgical staplers, and even ran the gamut of things such as SpO2 monitors, capnography monitors, both products that allowed to test the level of sleep during anesthesia, and even neurovascular devices to treat aneurysms and strokes or blood clots. So during that time, I also got to live overseas. I actually lived in Singapore for 3 years when I actually developed and grew a R&D center from 0 people to over 250 people. Within those 3 years, we launched over a dozen products, and within 5 years, those sales worldwide reached $100 million in US dollars. So I'd like to say that I've been an intrapreneur as well as an entrepreneur. So after leaving Medtronic in 2017, I decided to delve into the startup world here in the greater Boston area. I joined an angel investing group called Boston Harbor Angels, and I set up my own consultancy, Accelerated Healthcare Innovations. And during that time, I've really gotten to know exactly what investors are looking for, and that's exactly what I'm hoping to discuss with you today. So for the agenda today, it will start, of course, with this video that you're watching right now. Then we'll move to a Q&A that will be live. And then we're going to break down and actually have a series of lightning pitches from the participating companies. Whoever would like to pitch to me, I'm here and I'm willing to listen to your pitch and give you a short critique. We'll keep those very tight. They'll be more like an elevator speech than a true full presentation, which we'll talk about a little bit later. And then I'll give a little bit of feedback. So the first thing that I want to speak to you today is the idea of when you're pitching to investors, you need to put yourself in their shoes and look at things from their perspective. This slide shows 2 similar diagrams. The one on the left is your story, the entrepreneur story. The other is the angel investor's perspective. Let's start with your story, because obviously that's the thing that you will be pitching. Now, you notice that in the center of this, and I'll just move back here and point out in the center, you'll see the word the jockey. Now, you may be wondering what I mean by that. There's a joke among my BHA members and I that we don't bet on horses, we bet on the jockeys, which means you are the key to the pitch. We're going to be watching you and how you present yourself and your company. It's the most important part of the presentation. Now, after that, what we're going to expect you to do is right there at the top of the actual diagram, the problem. We always want to see that you're able to state what is you're going after. It's followed by showing us that you can give us a good solution. And then we're going to see that you can actually take that solution, that technological solution, and be able to turn it into a business model. And that simply means, are you going to be able to make money from this idea? Then we're going to actually want you to talk to us about the exit. Do you want to take the company to an IPO? Or perhaps you're just looking to be tucked in as an acquisition to a strategic or large corporate. And finally, we want to know what the deal is. We want to hear from you in your own words what you expect from us and what we can expect to get in return. How much money are we going to get back from our original investment, and how long is it going to take to get there? Now, as you are saying that, and as you are pitching it, it's important to be thinking about this right side of the slide, where the center of attention is your target, the angel investor. And here are the things that are going through that investor's head. First of all, how much money is in this venture so far? And how much does do the actual founders, including yourself, the entrepreneur, have invested in the company? Maybe it's all sweat equity, but maybe it's also personal savings or personal investments. We want to know that because that is the basis of where we start as far as the foundation and valuation of the company. The next question is exactly how much of my money do you need to get through this next tranche or to get through this next step in the company's development? But it doesn't end there. We need to know how much more money that you're going to need to be able to execute that entire side of the slide on the left-hand side of the slide to actually get to your exit. And that is when we want to understand what exactly is going to be my return. We're going to finally be looking for, it's not just about the entrepreneur, but it is about the people that surround him. So I've kind of laid out an overview of what we're going to discuss in detail. So let's take each of these points one at a time. First of all, the problem. We definitely want to know exactly what is the problem you're solving and why it's important. But most importantly, we're going to judge if it is of value by what is the basic size of the total available market. And generally, we like to see a potential market of $1 billion US or larger. Now, our thinking behind that is really several layers. The first is any market typically is dominated by somewhere between 2 to 3 top companies. And that means in the case of a $1 billion market, the maximum a company is going to get is probably somewhere between, say, $500,000 and $700,000, because the rest is going to be split amongst its competitors. The second point is that we definitely want to see the reason we want to see that is because that's where we begin to see valuations that could easily get into the billions of dollars, which means a good payout for what we put into the company. But it also sets up what we expect for a minimum amount of traction into the market you're penetrating, which typically you need to penetrate about 10% of the market before people begin to recognize you as a real player in the market. That's usually the point at which the incumbents, the large people that own the market, large market share, are saying, should we crush this person and the company, or should we consider buying them? So the next part is, after you set up the problem, the key is to present to us what your solution is. Typically, that's going to be your technology, your product or service that is going to fulfill the needs of the customer that is being plagued by that particular problem. We'll want to see that you've been able to provide a proof of concept that has demonstrated that your technology actually can solve the problem. The other point that we want to see at this stage of the presentation is we want to understand not just that your solution can solve the problem, but also that it can be protected. Typically, the way that technology is protected is through some form of intellectual property. Now, that is most typically patents, but there are other vehicles as well. There are copyrights, trademarks, and trade secrets. So absolutely, these are the different ways in which you can protect your technology. The investor is going to want to see how far along you are in securing and locking down that intellectual property. There is a special note here that many products in today's day and age have to do with software, and especially with the rise of AI and machine learning, involve algorithms. And there is a caution here. There is a lot of difficulty in using traditional patents in order to protect software. More and more courts strike down when companies have been able to get an actual patent to actually being able to turn that and keep it and not have it overturned in the courts. The other point is, if you heard about the recent battle between Oracle and Google, you'll understand that copyrights now have a much less strong argument in protecting your algorithms or your software. So definitely some watch outs to be there. Now, finally, you will want to know exactly who owns the IP. Many times as we sit here in the greater Boston area, great technology has come out of the universities. That does usually mean that the university has the actual rights to the IP and therefore will have to be paid a license. It also is sometimes happens that it's not the co-founders or the entrepreneur that owns the IP that they're bringing to market, that they may have licensed it from another third party. All of those go into assessing the strength of the solution that you're providing and pitching to the investor. Next comes the business model, which again, as I mentioned before, this is the point at which you really show that not only have you identified a great market, not only do you have a great solution in a product or service, but also that you can actually turn it into money, which means turn it into profit. It begins with sales. And the real question is, have you begun to show traction in your market? And if not, how are you going to get there? Now, many times there's a long runway before you actually are able to get onto the market. A good example of that is medical device technology or pharma or biotech, where you actually have to be approved by regulatory agencies before you can even sell. So there's going to be other landmarks that we're going to look to show that you're moving along with your business model. One will be that IP that I spoke of. Another might be the regulatory approval. You'll need to show us a strong revenue plan, at least 5 years out, because as I mentioned before, an investor is not just about how much money he's going to get, he or she is going to get out at the end, but it also has a lot to do with how long it's going to be tied up. Now, most entrepreneurs will tell us they can definitely get out within 5 years or less, but the statistics show that usually it takes somewhat longer, sometimes much longer, and sometimes as easily as many as 8 or 9 years before the company exits or is able to go to IPO, meaning that the investment becomes liquid and the investor can take their profits and move on to new investments. The other thing that you want to show is exactly what are the key milestones impacting that revenue. I gave 2 examples in the case of IP, in the case of regulatory, but also, in other words, how much investment might be needed in order to get to different levels of revenue. Finally, if you can integrate exactly the investment milestones with the valuation inflections that occur as you're increasing your revenue, that's going to be a very useful tool to understand the strength of your business model overall to the investor. Now we come to the exit. One of the key principles in things like real estate is the idea of comparables, meaning it's very difficult to get $1 million for your home if all of the homes that are like yours and are in the same neighborhood as yours are going for $500,000. Similar thing happens with companies. So what we want to see is we want to see that you've been able to go out and provide examples of similar types of companies. Obviously, they won't be exactly like yours, but ones that are similar in, again, the general area that they're working in and the basic problems that they're solving and the technology they use. And you're going to use those to show us, okay, these are other companies similar to ours that have either had an IPO or were acquired by other companies and who they were acquired by. It's the place where we first begin to understand the idea of multiples, meaning what is the multiple on our original investment that we can expect to get from you. Now, some of those that you will be able to find mostly will be on revenue, but that's not what's important to the investor. We want to know what the actual multiple will be based on the money in, okay? And of course, that is tied closely to valuation, but it's in that giving the investor the points about how things fit to investment versus the multiple is going to be the key. And finally, it's not just enough to show the comparables and what multiples have been obtained so far. It also has to do with extrapolating it to your exit. What is your expected multiple? What is your expected timeline? And give us options. A good example is this. Perhaps, in the case of a medical device or a biotech product, once you receive regulatory approval, is a point where a value inflection happens, and it's a possibility that a corporate or strategic might buy you out and acquire you. However, many times you're going to need to show traction anyhow, so you're going to have to invest additional funds to bring on, say, a direct sales force or line up some type of distribution channel in order to get to a certain level of sales. And with that certain level of sales, now suddenly your exit multiple might increase and increase significantly because of that additional time and investment put in. So this allows the investors who often have a say in the direction that your company goes once they invest in you to truly understand what is the way that they could maximize their profit or their return on investing in you. Now there is the deal. This is where you definitely have to be careful. You had to be able to outline to them what exactly money has come in to date. What is the current round deal? What is the vehicle of investment that you're offering? Is it a convertible note? In other words, the debt that can be later converted into equity. Is it straight up equity? And is there a lead investor? Meaning, has someone already come in, negotiated with you on your valuation, set a valuation, and set the terms for the investment? Whatever vehicle it is and whatever return it might be on that particular, in the case of debt, like what are the terms of the debt. That's called a term sheet, and those are what the other investors are going to have to agree to in order to participate in the round. Now, in the case that you don't have a lead investor, that means that you have to expect that you will have to negotiate a term sheet with the investor. And when you do that, the most important thing is settling on a current valuation that both you feel is fair for what you've been able to accomplish with your company and from the investor's eyes that your company is truly worth that valuation. Finally, make sure you do run through what you expect future rounds are going to be. Many angel investors or early stage investors feel that they're taking a big risk with you in the early days, and therefore they would at least like the chance to participate in later rounds where valuation has increased and to make sure that they are participating in the terms that, say, larger investors such as VCs, venture capital people, or corporate venture capital, or even family offices might participate in. So the last thing that you really want to make sure you do is you want to, again, show the investors not just that you are the star that's going to be able to ride this horse, be the jockey to bring it across the finish line. But, in terms of maybe a race car, that there's a good pit crew behind you. What is the team that is directing you, supporting you directly? And who are the advisors that are giving the advice to you along the way? Another big question about the advisors is going to be, and the team itself, is the team taking some of their compensation in actual equity in the company, which means they believe in your idea. They're not just simply a cash contractor. Also, are the advisors themselves, are they simply advisors, or are they also putting cash on the line as well, investments on the line? So when you do get to that point, be sure that you ask the investors to invest in you, and then move into a Q&A time frame. Now, I also like to give some helpful hints as far as general housekeeping about how you present. First and foremost, the slide deck. Too many times we see teams that have 30, 40, 50 slides for a 5 or a 10-minute presentation. They rush through their presentation. They don't get to show what they want to show, and the investors just become very, very frustrated. It's best to always limit your body of the slide deck to exactly what you need to what you're given as far as pitch time. If you don't know what that pitch time is, you should be asking ahead of time how much time you have. And then what you can do, which tends to be much more impressive, is to put your additional slides into an appendix. Sometimes it could actually, I wouldn't say unlimited, but a lot of slides that could basically cover what you think you're going to get for Q&A. That way, as you're answering the question, you can go back to the angel, show them the slide. They're looking at the slide as you give your answer, and it's very impressive to the investor that you've thought ahead about what the potential questions are. I've already mentioned about adjusting pitch length to the available time. That also means making sure that you try to answer as many questions as you can within the limited time that you're given. So make your answers short and to the point. One point I want to make here is that always be respectful to the investors. The investors have no obligation to invest in you. You may have given a perfect pitch. You may have the perfect solution to a massive potential opportunity in a market, but they may choose not to invest in you. Most importantly, always thank them for their time and thank them for listening to your pitch. The worst thing you can do is get into an argument with an investor about whether they should or should not invest in you. They might be critical of certain aspects of your presentation. The smartest thing is to simply smile and say thank you. Finally, above all things, be passionate. Keep in mind, their hard-earned money is going to be at work in you. They want to invest in somebody where they deeply see that you're committed to whatever problem you're trying to solve, and that you truly believe that your technology is going to solve it, and everybody's going to make money and people are going to benefit from it when you do this. So that is my basic helpful hints, but I do want to leave you with one other thought. Too many times, entrepreneurs, as they're pitching to investors, feel if they're just able to give them a little more information, one more positive to why they should invest in them, that the investor will say yes. But I want to leave you with the investor's perspective. An investor never takes a list of positives and adds them up and says, oh, perfect. He or she hit my number of positives and I'm going to go forward. Instead, they are looking for just one reason at all, not to invest in you. Therefore, it's so important to listen carefully to what their objections are and do your best to remove that obstacle, solve the objection and then move on to the next objection, because there will always be objections. So we're going to move into a Q&A that will be live, so the video will pause here for a moment. Now that we've had a Q&A time, we're going to move into the lightning pitches and critiques. So finally, thank you for your time today. I hope you found this valuable. If you'd like to discuss your idea, your company, your technology, and you're interested in perhaps presenting to Boston Harbor Angels, feel free to reach out to me through either this email or through my LinkedIn profile. Thank you.